What happens if another crisis comes in, if a recession unfolds and inflation is still too high? Well, that presents us with a big problem. That's what we'll discuss today. This is important for you and your family. My name is David Quintieri, and I am here to give you what you need to know and make sure that you don't see what you don't want to know, because all of that information out there is always clouding your judgment. It's making it difficult. So each and every day, I bring you the latest and greatest, and that's what we're going to do today. You came here for the truth, so let me unveil that for you. The very first thing is what it's all about. Canada has the highest household debt level in the G7. This gives us a little look at what happens when a country and their people take on way too much debt. You can see it here. They can measure it in different ways. Of course, with real estate being where it is, you will see that people are overly extended, and this is just one piece of the puzzle. Looking at it, I mean, there's credit cards, there's your cars, your houses, everything else, but mortgages currently make up about 3/4 of household debt in Canada. So they tell you that it's okay because it's real estate. It's okay because the prices of homes have always gone up, except back in the, let's say, early 90s, there was a problem. Yes, housing prices came down, but ever since then, they've been going up. So the real estate professionals, the mortgage, everybody connected with real estate, indirectly or directly, is saying, you don't have to worry, because their entire career, they have only seen prices go up. 2020, nothing happened. 2008 financial crisis, nothing happened. So you could see how their judgment is like this. But when you see people up to the gills in debt, it presents itself with a big problem, because there is a ceiling on what people are able to deal with. You think it's bad in some of these cities in the United States? We are looking at severe crises, just basically in every major city around the world. This is a crisis. This is debt with interest rates on top of it that you can't pay back. And you look at it mathematically and realize, wait a minute, this is like running right into a brick wall. And that's exactly how it is really being outlined today. It's not just Canada. Look at all the major cities. They deal with the same problems. And so we don't get paid enough money. We have to buy things that are costing more, but we don't get more out of it. Are you getting more? Not really. Maybe if you compare it to hundreds of years ago, you could say, well, we didn't have running water. Now we have running water. Okay, but just in the last, 20, 30 years, the advancements haven't been that great. But let me tell you, the prices, I don't know about you, but the prices haven't sort of kept up, okay? So looking at all of this, I mean, I could just tell you, this is one example of what has happened when interest rates rise. And it takes place in, the commercial side or the multifamily residence, where this one individual, he is a syndicator. He's one of thousands of real estate entrepreneurs in the US known as syndicators. Many have come under financial pressure and hold properties that they can no longer afford. So these guys, they raise a whole bunch of money. They said, hey, we're going to buy this real good thing, but they took on variable mortgage rates. And another thing about this side, the commercial side, they call it commercial, by the way, it is residential, but they're buying properties that are, let's say, 100 units, 300 units, whatever the case. And so in this case here, they may not get the loan. It's not like you get a 25-year, 30-year loan on a property like this, right? These are much more short-term. They're supposed to be stable, but it depends on the circumstances. And of course, if you're relying on interest rates to remain low, you're in big trouble. And we face that not regularly, but when that does happen, it doesn't matter how big you are, you're going to get wiped out. You could have one property, you could have 1,000 properties. But eventually, at some point, like, this is what people don't understand about the stock market, it's that, oh, I'm going to grow it bigger and bigger and bigger and bigger, and they're not really diversifying, and proper diversification, right? Not what they tell you in the mainstream. So just imagine this. I grew my portfolio to $6 million. Oh, I'm feeling so good. Wouldn't you feel real bad if you had a $6 million portfolio and then you got squashed versus a smaller portfolio? You don't want to see that, okay? The bigger the number gets, the harder it hurts. Let me tell you that, okay? let me tell you, let me cover some charts right now. Incredible to see this because you're seeing some data that's coming through and it's looking positive. But then there are other things not so good. I got some for you. You can see the general business activity coming from the Philly Fed. 9 out of the last 10 months, it is in the negative. What about this one here? The manufacturing survey, again and again and again, it's not looking good because of the strength of the economy after 2020 as well. There was a big demand and then that has come down. That's part of what's the problem in China as well. Same situation, right? But the output there is still high. It's just not where it once was. Of course, I'm always looking, by the way, whenever you look at any of these stats, make sure you're seeing this like is it year over year or is it an index? Like how are they measuring this? Because if we take a lot of the stuff from 2020 and 2021, like that was really skewed. So we want to be able to, keep that in mind. That's all. Okay, and you're seeing just several business activity indexes, just so many of them in terms of shipments, volume of new orders, backlog of orders, and so on. You might want to screenshot that. You might want to just pause the video, but you can see for yourself, several of these indicators are not looking good right now. And that's part of general economic activity declining, at least as we measure it year over year. Now, a lot of people have been asking, okay, with all this debt, with the increasing interest rates, all this stuff, right? Like the Federal Reserve, they are actively weaning off their balance sheet with their quantitative tightening policy, and that is the mortgage-backed securities and the treasuries. So who's buying it? Who's buying it? Who's buying it? Let me show you. You can see for yourself. Can you believe it? Households. Households are the biggest buyers of the treasuries. Can you, since the beginning of quantitative tightening, who has stepped in? I mean, it's unbelievable. The households have. And why? It's because they're going to get a better return there than they are with a lot of these other things. They feel that it's risk-free. And so, yeah, I'll buy some treasuries. I can get a few percent of my money and it's quote unquote guaranteed. Why not? So you see that. Federal Reserve, they sell off. The US investor comes in to save the day. But what happens if the markets suddenly change and you're no longer getting that return from these treasuries? Then we have a problem. And then the Federal Reserve has to start buying those up again. You have to understand this. This is where I'm tying this all in. Very important stuff. And you could see it right here and now in this particular chart. Now, if you have questions, let me know. I answer questions. In fact, have been doing so since 2011 every single day in the comment section. So you got to let me know what's going on inside your head, what you need to know. As we move into the next part, I want you to just think for a second of how many moving parts there are in any economy or financial system. And the US, as we see it today, there's so many things going on. And you look over here, if you got the blinders on, you're not going to see what's going on the other side, but it is something to point out. Like we got to look at all the different angles of this. For companies that need to borrow money these days, it pays to be big. The Federal Reserve rate rising campaign has put a notable crimp on the financing for companies with smaller payrolls and valuations. Yeah, it's very clear here. When you are borrowing money as a small business, you got to go to the bank, you got to go to the lender, you have to get it in these different ways. You're not borrowing cheaply. However, if you're a big establishment, they're going to the corporate debt market and they're getting it for significantly cheaper. They can actually issue debt. They can create money out of thin air and do it that way. Isn't that so interesting, right? But that's the way it works. Big businesses have this ultimate advantage that you and I do not. Okay? My business, other business, not this one, is something that, quite frankly, is very difficult to scale when you're working within your limits. So more people are ordering, more purchases are coming through. Okay, I got to take all 100% of my profits. I take them all and I put that into new inventory. If I need services, I have, companies that take care of the advertisement, this and that. I have to pay for that as part of this, but I'm not going to the debt market Okay, I can't do that. And then I'm not going to also go to the bank because now the interest rates are going to be there and I got to, think about that. Oh, wait a second, 5%, is it going to be 7% next time? Forget it. So my scaling process is significantly slower than it would be if I was some, AI tech company. It just doesn't work like this. So that's just a little bit of inside scoop. Small business versus big business. I hope you appreciate that and a little bit of anecdotes that I throw in there when I can to give you the personal information, hopefully to make sense of it all. I thought it was interesting when we're talking about the debt ceiling, the debt crisis. My favorite, Janet Yellen. And by the way, don't say Janet Yellen's your favorite. She's my favorite. Okay, anyway, the next accounting maneuver that Yellen can take in early June is one that will have no real long-term impact if the debt ceiling is raised. The Treasury can postpone investment in a pension fund for retired and disabled foreign employees. Once the debt ceiling crisis has passed, these investments can resume. It's a way to buy a little bit more time. So all of this because why? They have to pay the debt back, the interest on the debt, before they can pay out you, the individual, and your needs. Interest rates rise, all of these problems take place. Small businesses take a hit. You're looking at the pension funds in this case here. I mean, just one after the other after the other. Isn't it crazy? But that's the way it works. And so for a lot of people, what they can do, I think it is really, really key to just pay attention. I want to cover this just really quickly. It's just saying that there's way too much investment in some, very few companies, 5 companies. They mentioned Apple specifically, saying it is ridiculous that they have so much of the market, and so there's these risks that are all piling up now today. That's why we need to be broadly invested. We need to take our time with our investments and actually study them and learn from the mistakes that we've made in the past. Don't double down on something you think like a gambler wants to do that big mistake, okay? So we got to learn what we can, and at this time we don't want to be exposed to anything that is, potentially higher risk, okay? So we want to have the balance, and what I mean by that is essentially looking at the different investments that will be there, time tested and true, that would be something that is like a household name. That's where we want to be right now. We don't want to take those high risks, even though the market's been performing very well overall, the real estate and so on. We can scale that back a bit. We can watch and we can, get into things. I'm not saying don't invest, but be careful. That's all. That's my message, and I'll see you tomorrow. Take care.